All right, guys, welcome back for another video. In this video, I want to discuss the dollar currency index, or the DXY, or the DXY as it's sometimes called. And on this chart, I'm looking at the dollar currency index on the weekly chart. The dollar currency is just a measure of the strength of the dollar in relationship to other fiat currencies, a basket of fiat currencies, primarily those issued by the central banks of G7 countries. Think Japan, ECB, Bank of Canada, those type of banks. And right here, I've got marked off on the chart the areas in the market where the Federal Reserve has pivoted or changed their monetary policy. And here you have, after the March 2020 event, debasement of the currency in response to the COVID pandemic. And then you see the dollar sell off in relation to other major currencies. And then here is where the Federal Reserve changed their course and announced a plan to raise interest rates. And that's when you see DXY going absolutely parabolic. And so now you're sort of left with the market sort of coming down to trying to guess what the next move of the central bank will be, right? And maybe you think, like, well, I can just take what their word is for it. But maybe if we just draw our attention to this graph right here, you can see how it's very difficult to take the Fed at their word for what their projections are for their monetary policy, because this graph basically shows you what their publicly stated projected goals are and the reality. So here you have QE, and then here they probably, in response to QE, they're like, well, inflation is kind of getting out of control. We need to taper our balance sheet, or taper the monetary supply, run our balance sheet off. This is how much we're going to run off. Well, in reality, they didn't do that. They printed more money. And then after that, they said, well, we're going to run our balance sheet off like this. But in reality, they didn't do that. They just kind of maintained it, but definitely didn't roll off. And then here, you probably had them committing again, saying they're this time they're really going to do it. This time they're really going to roll off their balance sheet. Well, of course, they don't do that. And here again, here's another projection. Reality is a little bit greater than the projection. Here as well, you have a projected runoff, and then you have quantitative easing, you have reality. And again, we're at that same point in the market, and everybody just kind of believes that this, will continue to play out despite the history of it not playing out. I mean, if you think about this as an edge, right? This is 100% edge, right? The reality is always more money printing than the projected goal, right? It just always is. Now, of course, is it possible for them to, run their balance sheet off even more than they projected? Yeah, it's technically possible, but it's not It's not characteristic, right? The characteristic thing is for them to never meet those projections, never meet those anticipated goals, and just create more money. So going back to the dollar currency index, one thing that is unique about central bank policy is that you have the Federal Reserve pursuing a path of higher interest rates. Meanwhile, other major central banks are pursuing completely different paths. So you have the Bank of Japan that's printing unlimited yen to try to support their bond market. We can see that by going right here. You have the failures of Japan bond transactions spiked to the highest since 2008. This is a incredible sign of distress in the bond market. And in this case, it's the Japanese bond market. This is what you saw in 2020 during the COVID pandemic. What caused the Fed to step in and support the bond market and print a ton of money was the U.S. Treasury market went no bid, meaning there were no bids. And the Fed stepped in, acted as the buyer of last resort, and that's essentially, the rest is history. But you have that same phenomena occurring in Japan right now. And the Fed and the Japanese bank is printing money to try to support their bond market. So totally different things that are happening here in the U.S. Speaking as American, of course. And right here you have the French baseload electricity 1 year forward price and the German baseload electricity 1 year forward price. Basically, this is showing you that energy prices in Germany and France are going parabolic. I mean, just going crazy, right? 5x, 4x, 6x. So energy has a real Europe has a very real energy crisis on its hands, and it's stuck between a rock and a hard place. If they raise interest rates, a lot of the Southern European member countries in the European Union will default, and then that If that happens, that basically represents the end of the European Union from a financial perspective, as different member states break off, form their own national currencies, and then debase their own, uh, you know, new national currencies in a race to the bottom. And so those are a number of reasons why the European Central Bank cannot pursue the same monetary course that the Federal Reserve is pursuing currently. You know, here's just another graph of the purchasing power of the US dollar. Now, if we go back to the Dixie, it's going parabolic, right? But it's important to keep in mind that it's going parabolic relative to other fiat currencies. So, I mean, that's great if you're trading Forex and you're going long US dollar in relationship to, the euro or the Japanese yen. But in real terms, what we really care about is how much the US dollar is able to purchase, right? How many actual goods and services are we able to buy with it? And the purchasing power year over year, if you zoom out and eradicate the noise and the short-term volatility, it just goes straight down, right? It goes down so much that it's almost like a dead heartbeat. And that's at the end of the day, we don't really care if we're debasing less than other currencies. I mean, it's not, if you had to choose one, you would choose to debase less relatively. But what you ultimately care about is, are you debasing in real terms relative to things that are scarce, right? So I think that's the important part, right? You want to compare currencies to things that are scarce, right? You don't want to compare them to other currencies that are debasing at a faster rate. Just going here, here's the Bitcoin versus US dollar chart. You can see that, there's an inverse correlation between the dollar currency index, or the dollar in general, and Bitcoin. That's not necessarily because the Bitcoin, trades against the US dollar. Bitcoin trades against every currency, but it's more than that. It's kind of what's going on in the macro markets. When you have when the dollar currency index rises, or the dollar rises, you have a world filled with dollar denominated debt, right? All these liabilities that, as people are struggling to meet their liabilities, and they have the most liquid asset in the world, which is Bitcoin, they'll sell that liquid asset to meet their liabilities. They almost have to, if they, if they didn't prepare for that moment, which is really most people. And so here you have realized losses in BTC. This is basically showing you that the realized losses is approaching the third highest level of all time. It's eclipsed the peak from March 2020, and you have to go back to this period here in 2013 or 2011 or maybe 2012 to compare to it. And, right here, this was actually, it looks parabolic, but this rundown here was a 80% drawdown in about a period of a couple weeks. So you had to flush out. Same thing here. This is actually more of a prolonged bear market right there. But yeah, this is where the fiat maximalists are taking victory laps, and this is where the sentiment of the market, at these areas, is that the dollar is a superior asset. 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 It's really not. It's just how the market sentiment is generally contrary to the realities that exist, right? And on the flip side, not many people are saying the dollar is the superior asset at the market tops, right? This is when people will generally say cash is trash, cash is trash, cash is trash, cash is trash, cash is trash. Again, just typical market behavior playing over and over. This slide is just showing you that the bond market is getting fucking destroyed. So investors with long-term time horizons are kind of, stuck between a rock and a hard place. What this graph is showing you is that the year-over-year return for world government rated bonds is the worst it's been since the Civil War. So you have to go back 200 years of crises, past all the crises in 200 years, to get to the period in history where the U.S. government almost faced total annihilation, to get to a period of losses that rivals this year, 2022. And it also represents the breakdown in the 60-40 portfolio, where typically you had standard portfolio construction was 60% equities, 40% bonds, and they enjoyed an inverse correlation, right? When one went up, the other went down, and they balanced themselves out. Well, now the 60-40 portfolio gets crushed on both ends, right? The equities and bonds go down at the same time. You've had one of the worst years ever since really the Great Depression in stocks, and one of the worst years ever since the Civil War in government bonds. So kind of illustrates, but here, this is interesting. So this is the Coinbase Premium Index, which, shows you that basically, essentially, whether you like Coinbase or not, maybe you don't like their fee structure, but Coinbase does control a lot of the institutional demand for Bitcoin, right? They just have more institutional clients than anybody else. So if you see a Coinbase premium, relative to other Bitcoin exchanges, what that tells me is that that's a sign, a canary in the coal mine for institutional demand, right? Institutions are flowing through Coinbase. They are the sort of the gatekeeper to institutional demand. And then if you see a premium there, it shows you that institutions are entering the market and creating that premium. So that's interesting, right? Bitcoin's supply side is absolutely fixed, but the demand side is, demand is always fluctuating and it's always subject to human emotion, whereas the supply side of the equation is very fixed, very controlled, at least in Bitcoin's case. So when you see these demand, when you see volatility get as extreme as it is in the Bitcoin market, you can see that demand fluctuate in the same volatile fashion. So, whereas you've seen demand dry up, there could come a day where, a switch flips and all of a sudden that demand flips the other direction in the same type of volatile nature that it flipped to the downside. Now, just going back to the Dixie chart, I'm not going to mention it here, but Fidelity Digital Assets just posted a new research paper making the case that Bitcoin is a risk-off asset, not a risk-on asset. And I think with everything that's happening, I won't go into the article, I'll save that for another video. But I think what's happening now is that this global deleveraging event is destroying people's portfolios, taking every asset down with it. But with every boom and bust cycle, there is another boom cycle, right? Another credit expansion. And I think that credit expansion will occur whenever the Dixie tops out, right? And Dixie's going parabolic. One rule of the market is that every parabolic rally always blows off. There's never been a parabolic rally that doesn't blow off, even in, Bitcoin is a prime example. So it will blow off at some point, and that will probably mark the beginning of the next credit cycle. And I guess the point I'm trying to make is that in whatever credit cycle follows, the asset allocation strategies will be different from these major funds. And what that means in practical terms is that some of the correlations that we've come to be accustomed to will break down because the whole strategy and allocations will be different in the next cycle. And I think, just personally, my personal opinion is I believe the market is starting to realize, and these big funds are starting to realize that Bitcoin shouldn't trade like a tech stock, right? It's not a tech stock. It's not an equity. It should be the portion of your portfolio that represents gold, right? How would you allocate to gold in a portfolio? And this is not just my opinion. This is Fidelity Digital Assets. They're one of the largest asset managers in the world. This is not just some random person. There are people that, the rest of the market looks up to, other asset managers look up to. So they sort of set the tone and set the strategy. And they've chosen to allocate 5% Bitcoin to a lot of their non-crypto funds, just their traditional funds. They find that a 5% Bitcoin allocation is ideal. And I'll do a follow-up video on that, but I just wanted to kind of touch on the dollar currency index, how it relates to Bitcoin, and when you can expect, what you can expect from Dixie. Now, I don't want to make a prediction of when the Dixie will top out. That's not what I'm trying to do. Let other people call tops and bottoms. That's not my thing. But all I'm saying is that when the market goes, any market goes parabolic like this, it will it will top out. It will blow off, and it's very difficult to predict when that will be. The market can go a lot further than people predict, but ultimately, at some point, it will blow off, and that will catch people in the market off guard. And I think it's just important to be nimble and flexible to adapt to those changes that exist in that period of time whenever it comes to pass. Anyway, I hope you guys like this video. If you feel like this type of content, just leave a like on the video, subscribe to the channel. I'll catch you guys in the next upload.